Hello, good morning, and welcome to Stonehearth Capital Management's quarterly webinar series, CIO's Corner, for Q2 of 2026, featuring our Chief Investment Officer, Chris Gauthier. My name is Ben, and I'm the Associate Advisor at Stonehearth Capital Management and have the pleasure of working with Chris today on this webinar. Before we dive into today's discussions, I do just have couple quick housekeeping notes. First note is to please use the Q&A button at the bottom of your Zoom window to submit any questions throughout the webinar. We will aim to answer all questions during the Q&A portion at the very end. The second note is if we do run short on time and are unable to answer your questions, either Chris or myself will follow up with you directly to ensure that your questions are answered. And now I'm excited to introduce Chris Gauthier, Stonehearth's Chief Investment Officer, who's over 25 years of experience in investment management. He leads our firm's investment policy and strategy, focusing on asset allocation, research, risk management, and portfolio management. Chris, thank you for being here, and I'll hand it back to you.
Thank you, Ben, for that wonderful introduction, and good morning, everyone, from a sweltering Massachusetts here, baking in the heat. But thank you for joining us. Today, we're going to take a look at the current state of the investment landscape, how best to navigate the choppy waters we're seeing. This quarter, I titled the presentation AI I Ran, Nothing Else Matters Until It Doesn't. Really sums up what we're seeing right now, right? Investor sentiment and the reaction to every headline, social post, it's just driving chaotic short-term performance, even though, as we're going to see throughout the presentation, there is long-term support for risk assets, and that does remain intact. I always, as we often do at Stonehearth, return to one of the greatest investors of our time, Warren Buffett, for guidance when these things happen. He's often said, that in the short term, the market is a voting machine, right? Moved by sentiment, feeling, the latest headlines, and we're certainly seeing that now. But in the long term, it's a weighing machine, right? Where fundamentals and earnings drive performance. We agree wholeheartedly, but we do have a slight twist on it. Rather than view the markets through such a narrow lens as he does, we believe you really need the fuller picture, right? You need to include sentiment, momentum alongside fundamentals. That's that combination, the foundation for building long-term wealth. So today, we're going to take a look at the current environment through those multiple lenses. We're going to use technical and sentiment indicators. We're going to use macro, think of the economy. And of course, as always, fundamentals and valuation, which matter a great deal to the future trajectory of asset prices. And always with the goal, finding the signal through the noise. So with that, let's start with where we've been, looking at Q2 2026. And as you see, it was a very good time to be an investor in risk assets. Definitely clean risk-on growth led tape. We had the NASDAQ led the way higher, up almost 28% in the quarter, reversing the decline we saw in the first quarter, followed by EM with up a little bit over 21%. Really driven by the same factors, right? By their highly concentrated exposure to the AI build-out. But as we'll see in the next chart, it's going to be a little bit different story this time than we're used to in the past. We also saw U.S. lead international. We had the U.S. small post a nice big rebound in the quarter, and S&P 500, while trailing a little bit, still posted a very robust 15%, with international developed down there 8%. Fixed income, which is in purple, were flat. And commodities, which are in yellow, were the laggards, right? Investors continued to hope for a successful resolution to the Iran conflict. They kept getting their hopes up. The latest headlines suggest maybe something else is in the cards. But we'll have to table that discussion until the next quarter as we see how it plays out. Like I said, the story may be different this time, right? The story beneath the story is this rotation we're seeing within the AI trade. And we're looking at year-to-date numbers, and we're looking at, in the blue, up 113% as semiconductors, right? So this is the benefit of all the AI spend, right? And we look at the Mag 7, the old Mag 7 that we used to fondly remember, down 2.5%, right? So semis became winners, the Mag 7 became laggards, right? And as the market often does, it is moving on from past winners, right? We anticipated this move, right? We were positioned for it. The portfolios benefited greatly from this shift as our overweight to the picks and shovel infrastructure really did help performance. So when we're looking at performance, that we're still seeing good solid returns, but it's a little bit different underneath the hood, and there's new beneficiaries in the marketplace out there. So that's kind of really where we've been. And now we're going to take a look at the current state of affairs to give us a path to where we may be going in the future. And we'll look at the Fed. And they're looking at the federal funds rate going back to 1993, which is the brown line. The brown line is where it's been, and we can see right now that we're currently at the high end 375 and the low end 350. They don't give a point estimate anymore. They give a range, which is 350 to 375. And we see those dotted lines, those expectations. We look at green, those are the market expectations. We look at blue, that's the Fed. So thinking about the Fed and what happened, as you may or may not be aware, we got a new Fed chief in the quarter. President Trump nominee Kevin Warsh, tough name if you were born and bred in Massachusetts, but we'll try our best here. Took over as leader of the Fed, right? And his first press conference took a very much more hawkish tone. When we met last time, we were pricing in a few different rate cuts, and now we're seeing actually rate hikes in the data. And you can see investors in the Fed are converging on that higher for longer in the short term before a slight slow decline. I read is that this may be too aggressive stance, given the current administration's love affair for lower rates. We just have to wait to see how this plays out. And there may be, and I would say more and more looking at the Fed rates, we want to look at what he does, not so much what he says. But for now, what we're looking for is more higher for longer than we did last quarter. And we're seeing that in the numbers when we look at the yield curve. And what we're looking at here is just yield curve for US Treasuries. So think when the government borrows money, they issue Treasuries. They can issue at different maturity dates, 3 months all the way up to 30 years. And what these curves represent is just the interest rate you can get at each one of those maturity dates. And we look at the light blue line from last year compared to where we are now, which is that dark blue line, June 30th, we see that the curve has definitely shifted higher and re-steepened since year end. Really on this expectations that the new Fed chief came in and said, we're going to raise rates, or we're going to be more hawkish. He didn't actually say we're going to raise rates. He's just going to concentrate more on inflation and raise rates. Now, I know historically rising rates have not been good for markets, and they're not always the case if they're measured and telegraphed. The markets can kind of, which is shown before in prior presentations, can manage through it. But what it is good for is fixed income, right? It's not all bad. Higher rates do make fixed income more attractive. And they're more attractive than they've been in a while with what we're looking here. We're looking at those brown bars, which is a 15-year range of rates you can get on different asset classes in fixed income. And you look at that purple, which is the median, you can see given the blue dime in the current state, we're much higher, right? So it's much more attractive to invest in fixed income. When we look at investment grade corps, now your corporate bonds, you're earning a little over 5%, where on average over the past 15 years, you're earning just a little over 3.5%. So again, much more attractive. They have been in a while, and they can still play a very important role in the portfolio. So that's fixed income. Now we're going to turn to the economy, and we're going to start with oil, which is probably having the biggest impact, at least with the headlines in the marketplace. So down from the highs, you can see up almost at 115, but still higher than the war started. And even from a year-to-date basis, before the war started, it was heading in the wrong direction. It was still up 42%. So every time we hear about how oil's getting better, the war's ending, and yes, it's getting better from a standpoint of $115 oil that we had in April and May, it's not getting better from the beginning of 2026. Or even when we look at a longer time frame on the bottom chart there, going back 1 year, oil's still up 26%. Right? That's definitely not going to help inflation. One reason why they may be more hawkish. And you obviously read about how bad this is for the economy, and it's not good, right? High oil prices aren't good, but the US may be better positioned this time to withstand energy shocks, which is what we're showing here. So on the left-hand chart, you can see retail gasoline prices over the past few years. And I really want to concentrate on that orange one. That's 2026. And indeed, we saw a big spike up from the war. But again, it's not as high as it was in 2022 when it's up at $5. It was only up at $4.50 per gallon. I say only, 4.5 is very expensive, especially from where we've been. But given that we bombed one of the major oil producing companies, shut down a strait where most of the oil flows through, you would expect a higher reaction. I mean, we're talking about, I heard things $180 a barrel of oil, $200, $7 gasoline. We never saw that. One reason why is that the U.S. is in a much better position. So look at that top right-hand chart, the U.S. net imports of petroleum. And what that's showing is that unlike in the prior energy crisis is we're actually a net exporter of oil. So we create enough oil here. Oil is a global product, is priced in US dollars and globally priced, but we're in a much better position to withstand it. And then when we look at the bottom chart, we're looking at different income levels and what the impact of higher gasoline prices are to them. We look at that bottom 20% of consumers, and you see that 17% of their spend is from energy complex. When you go all the way over to the right, you look at that top 20% of consumers, they spend a lot less of the disposable income on this, so they have a less of an impact. And as we're seeing in the next few charts in what we'll call a K-shaped economy, which I'm sure you probably heard of, that top 20% is really driving a lot of economic activity from the consumer standpoint. So they're less impacted by higher oil prices. So I think this is a great lesson, and you always need to look beyond the headlines and at the actual data for the signal. There are higher energy prices, and we're seeing higher prices across the board, right? Inflation is just still too high. This is updated as of today. We get the latest readings today, and we actually got some good news on the short term. So we're looking at inflation, or in layman's terms, prices paid by consumers. Top chart in pink is consumer price index. That's all the prices. See, it definitely took a little dip down to 350, but a lot higher than the stated goal of 2%. So again, definitely like one data point coming in lower, but we need to see that trend really continue to get too excited. We look at the core consumer price, which the Fed looks at more, which is that blue line. That takes out energy and food. I'm not going to go on my rant on why they do that. It just seems stupid to me because everybody does pay for food and energy. But that number still, even taking out the volatile food and energy, is still at 2.6, right? Still way too high. And then the purple line, producer price index, that's at the beginning of the production process. And you can see that's definitely headed in the wrong direction and very elevated. And that should potentially bleed into those other consumer indices eventually. But we also did see good news on the expected change in inflation rate. That's that green line. To me, that's the really important figure because if you think about how inflation works, inflation expectations, if you're a consumer, you think you're going to get higher prices in the future, you first reaction is I better go out and buy something now. Well, when you buy something now, that creates demand. When you see demand, that raises prices, and you see we get into a vicious feedback cycle. So as long as those remain anchored, we're pretty good with the inflation numbers. So overall, even though we had a slight drop, inflation is still too high, and it's impacting the economy. And one reason why the Fed has been talking up being hawkish in the market. Another piece of the economy is employment. Again, this is helping consumers weather higher prices, right? The labor market, well, it's not going gangbusters. It's still very resilient. You look on the left-hand side, those blue bars are monthly payroll gains. I rather really concentrate on that 3-month average. That's that brown line, and not so much the levels, but the trend. That just kind of smooths out the dips and it takes care of some of the adjustments that they do to the numbers after they post them. And you see it's headed upward and to the right. That's good, right? So still resilient at the aggregate level and is providing support for the economy. We look on the right-hand side, and you're still getting decent nominal wage growth at 3.4. And if inflation comes down and that goes above inflation, you can get some really good economic numbers there. So again, not falling off a cliff, but not great and still pretty strong at the 3.4. Unemployment rate is definitely ticking up, given some of the layoffs we're seeing, especially concentrated in the tech world, but still at a 5.5. It's showing that from the labor market perspective, it's still resilient and helping economic growth. And what is definitely helping economic growth, maybe not themselves so much, is the hyperscalers. And when you hear hyperscalers, you can think the old Mag 7s. We look at the names on the top left, Alphabet, Amazon, Meta, Microsoft, Oracle wasn't part of it, but those 4 names make up more than half of the Mag 7. So arguably, when you look at the chart and what they're spending just to build out the AI, that's that, expected $758 billion in 2026, growing to 925 in 2027. They're arguably helping the broader economy. But more than it's helping their own near-term performance, right? As they continue to pour money into it, you can see their free cash flow on the right-hand side by that represented by the brown line, is heading down in the wrong direction, right? And I think that's the next big trade, and kind of what we're seeing in the market from that rotation is that investors are starting to say, yes, we need to invest in AI, but are these hyperscalers actually going to get the benefit of all that investment? Maybe that benefit is going to accrue to other parts of the economy, like semiconductors, the memory makers, something we kind of expected would happen or play out in this trade, that you just can't keep throwing money at something without getting a return on investment. And while it helps economic growth, the return on investment is trickling down to other companies. So that's been the real driver of the current GDP growth. So we talked about the K-shaped economy a little bit, and I want to kind of, unpack this a little bit more. So we look at the K-shaped economy, which continues to see a two-track economy, right? That's that K-shape, from multiple different angles. The first one on the left-hand side is the K-shape between labor and corporate profits. And you can see from the chart that the corporate profits in brown have really pulled ahead of labor's share of national income, right? Hasn't been a new story. It's been there for a while. It's been happening. That gap is widening, but it really has accelerated recently, and it's at its widest ever pin. So the way to look at that chart is that more and more economic growth is heading towards the corporate rather than the labor. And again, it has all kinds of implications for society, but from economics, it's really helping corporations and their earnings, as we'll see in the next few charts. When you look to the right, now we're going to look at the consumer as the K-shaped. And when we look at the consumer as K-shaped, we're thinking about those top 20% of earners compared to the bottom 20% of earners. And you can see from the top hand chart, the top 20% of earners account for an outside portion of income, 51%, but also spending. Almost 38% of spending is driven by those top 20% of the consumers. And also, we remember when we look at the gas prices, they're impacted a little bit less by the rise in gas prices. You can see why they can continue to keep spending. Another way to keep spending is the bottom chart, that net worth growth, right? The spending driven by the uneven growth in net worth accruing to the top 20%. They are the ones keeping spending high and helping to push GDP higher in the economy. So we see decent economic growth. And we see that in the surveys. So we've shown this before. The red line is the services, right? Think consumer, and manufacturing is the green line. Think industrials. They're diffusion indices, right? Based on survey data from corporations. Government, well, not the government, company for the government reaches out. They're asked them multiple data points, things getting better, staying the same, getting worse, which is then added together with a reading above 50 indicating economic expansion. And just looking at it first glance, we can see weakening for sure, but still very comfortably in expansion territory, right? 54 for consumer, 53.3 for manufacturing, so safely well above that expansion territory. So you take those two together, right? They're really indicating the path of least resistance for future economic activity is expansion. So we're seeing the AI hyperscalers invest in the economy. We're seeing the top 20%, the K-shaped economy consumers really supporting good economic growth, and we're seeing it flow through into the numbers. And speaking of economic growth, we're now going to look at the GDP. We're going to look at it from a different lens. We always show this chart, but when I say a different lens, this is not the GDP the government announces. When they announce GDP numbers, they're always looking back, and it's usually looking back 2 or 3 months. So it's a great indicator of where we've been. It's a great indicator of how much economic activity has been happening before. Doesn't really tell you a lot about what's going to happen. So we'd like to use this GDP now from the Atlanta Fed. What they do is they take a whole bunch of economic data that's happening in real time. Think the PMI surveys we just saw, labor market data, some of the consumer data. They put that all together and say, given what we know about the past, given these current readings, where would we expect GDP to fall out? And what we're seeing is that's pointing to further growth ahead, right? And again, like we've talked about, driven by that top 20% of consumers and the continued willingness of hyperscalers to keep building out AI compute capacity. Definitely need to keep a careful eye on this, right? Because we don't know how long the AI compute investment's still going to go on. And we will be getting a new read on this as Q2 earnings seasons just started this morning. And we can see when we turn to the equity market and the earnings seasons, expectations are very supportive of equity prices, right? Good earnings momentum. And we're at historically high upward revisions. When more estimates are rising, it tends to be good for equity prices. We look at the market, we look for what we're expecting is 22% growth. That's the market cap weighted index of the S&P 500 year over year growth. Look at the median stock at 9. Again, a little bit lower than last quarter, but last quarter was really an exceptional driven by some other income, which is really SpaceX. So they really had 17% growth. So increased growth also in Q3. So as long as they meet these, this is good. And that's the good and the bad with this, right? AI infrastructure stocks are expected to contribute nearly 60% of the S&P 500 EPS growth this quarter, with Micron and Nvidia together accounting for more than 40%. So concentration risk hasn't left, it's just moved over, right? So the concentration risk now is to make sure this AI trade keeps on going. And if we see any signs of it slowing down or investors get a whiff from the earnings reports that we're going to see over the next few weeks that investment is slowing down, we could see a readjustment in the marketplace, and something we're watching for closely as earnings season rolls out. So the other side of earnings is valuations. We're looking here at the S&P 500 again, looking at the forward PE ratio, so based on forward estimates, not what's happened. No doubt, right? It's valuation is still not supportive at current levels. It's still very stretched, but down from extreme levels, right? It's at 20.4. That one standard deviation is what we label as extremes at 20.5. So I know it's just a little bit below, but hey, I'm an optimist at heart. It's a little bit lower. So it's down from extreme levels, but it is a headwind, not a tailwind in the valuation picture. And valuation is never a big driver of short-term performance, but it sows the seeds for what potentially could happen. And if you think about valuation from a perspective, if something bad happens and you're at extreme valuations, you're more likely to fall further than if you're at lower valuations. So that's what you hear us talk a lot about is the margin of safety. It doesn't drive short-term trading, but helps us position for the long term and where we want to position our portfolios. The flip side of valuation is technicals. And what we're looking at here is a long-term chart of the S&P 500 on a weekly basis. You see that black and red line, that's the price performance on every week of the S&P 500. And you can see it's a very strong chart, upward to the right, continuing to hover around all-time highs. But even looking underneath the hood and we look at the technicals, you can see that it's well above that blue line, which is the 50-week moving average. Again, that's what we call support and resistance. So long as it hangs above that, that is positive technical indicator. We look at the other moving average, the red line, the 200, combined with that blue 50, and we see that they're upward sloping to the right. So prices are headed in the right direction. We look at that top call out, the RSI, relative strength indicator. That kind of is an indicator to indicate when the stocks get too ahead of themselves. And we usually use 70 as a cutoff. You can see that we're close to it, but not there yet. So again, that's still indicating that we may have some more room to run here with equity prices. And we look down the bottom, the MACD, is a measure of short-term to long-term performance. Is a short-term positive performance increasing or decreasing? And as long as we see that black line above the red line, we can say that short-term performance is increasing better than longer-term performance, which is a good sign for equity prices. So that's a lot to say in one breath. So the technical and momentum do remain constructive, right? The takeaway for investors, even with stretch valuations, the strong signal from the underlying technical picture is really keeping or should keep you in the game for U.S. equities. One more chart in U.S. equities before we turn to our risk modeling. So I want to take a moment to put the current equity environment in perspective. And this is some great data from Goldman Sachs. So I want to unpack this. So what we're looking at here is a chart going back, to 1925, and what these brown callouts are. Some of us may remember, at least read about, are problem overextended markets we've seen in the past, 1929, 73. I'll get to more recent terms, 2000, we all remember that, 2021. So times in the market when it really fell out of bed afterwards, overextended and had a little bit of a sell-off. And what it's doing is taking those instances, looking at the current data from market valuations, right? We've seen that, from the concentration risk we're seeing, and the recent returns for how fast and how short a time frame they climbed, putting that all together in one factor and saying, how does that compare to those previous overextended markets? Are we close to it? And yes, we are close to it, but this is not a predictor of a top, right? But a very good reminder that this combination of conditions has preceded corrections before. So investors, especially asset allocators like ourselves and risk managers, really need to focus on risk management, more importantly than identifying opportunities at this level. So risk management is going to be key. So turning to risk models, as long-term listeners know, we use two different risk models. The first one is an external model from our research partners at Ned Davis called the Ned Davis Research Fab 5. It's 30 different indicators broken down into four categories, which you can see down here. Tate, which he has as neutral, sentiment, neutral, and then monetary, and higher interest rates are bearish, combos more international is bearish. So the big takeaway for you, it's unchanged from last quarter, right? So Ned Davis research, at least for the Fab Five, remains a genuine caution signal and is a caution, but it's not the end all be all. We do have other models. So we use our own internal risk model, and that's complementary, right? Not duplicative. It's supposed to enhance this and give us a better picture when we look at the total picture. And unlike NDR, our model improved slightly in the quarter. You can see last time we met, we're at a -1. Now we're currently, as of June 30th, 2026, at a +2. And really due to a rise in the structure of the market, as we saw improvements in sentiment, the right parts of the market started to outperform. We saw cyclicals overcome staples. We saw correlations kind of drop, which means stocks were moving on fundamentals and not just seesawing back and forth on headlines. We saw a small increase in breadth, right, on that rotation trade we talked about in the beginning of the presentations. More companies benefit from the AI spend of a few, right? Still not outrightly bullish, right? We still have positive technical structure, positive reversion, valuations are still negative. And look at the macroeconomic environment, like we saw in the presentation, positive. Qualitative still -1. Again, not sure we believe Kevin Walsh at his word, and given all the geopolitical turmoil, we don't feel it's should be positive for the qualitative. That's more of a negative impact on the model. Um, so again, still not outrightly bullish, but the signal through the noise that there is enough positives to outweigh the negatives. And while we want to tilt into risk assets, we really have to be careful with security selection and exposures. It's not time to push all the chips into the center of the table. So looking at our current asset allocation, and we're looking at this relative to our moderate benchmark as of June 30th, 2026, positions could have changed since then. Um, Remember, I talked about last quarter, we had a slight defensive trade. We did do a trade in this quarter too. We took some profits, right? So we had a good exposure to that semiconductor trade, anything up over 100% in 6 months. Anybody in the risk management should probably take some profits in that. And we took the opportunity to realize some of those profits and reallocate to a better piece of the equity market. But we remain overweight equities. We look at the US, we're underweight, and we look at it from a perspective of the technical picture is very strong. We saw that in the S&P, but we have a very, very most expensive market of all the equities in the US. And then we look at international developed, and we have a much cheaper market, closer to the low end of the valuations, but just doesn't have the good technical picture. So again, they're not bringing the best of both worlds there. Where we do see that, or is the emerging markets, which we are overweight and where we're taking risk in clients' portfolios because we like the setup there. Is it the cheapest? No, but it's not the most expensive. Does it have the best momentum? No, but it has really good momentum. So on balance, it has a better setup and more likely to help clients than the other two, the United States and international developed. Fixed income, we did a little change this quarter. You can see them a little hat trick there, includes cash and defensive hedges. Rather than kind of have that opportunistic bucket, we're going to roll everything into fixed income. In cash, we're neutral, right? We just have transactional cash. There's no position in cash whatsoever. We do have a small defensive hedge. Remember, we talked about that last quarter. And we saw with the higher rates that income is very attractive. So we'll overweight the fixed income piece or the lower volatility piece of our portfolio. So again, really well positioned for the rest of the year. So again, unless we see any really signals change, this is how we want to be positioned as we see 2026 roll on. So before we turn it over to questions, I want to leave you with a few takeaways today. So again, like we started out, rotation, not a breakdown in markets. Investors aren't leaving the equity market. They're just reallocating amongst that asset class, really taking advantage of those companies that can take advantage of the AI spend by the hyperscalers. Economy is showing some signs of slowing, but again, it was from a position of strength and it's still showing decent help. The K-shaped economy with those top 20% consumers still driving consumer spending, and the AI trade continues to march on. And when I say the AI trade, I mean the AI investment trade. Fixed income, the higher rate, still viable given the higher level of yield, still plays a very key important role in portfolio. Equity market remains stretched, right? But fundamentals and technical backdrop is when combine them together, is still supportive. And finally, the signal remain invested, right? But have a higher focus on risk management than chasing any of the momentum and noise in the marketplace. You really want to have control of the risk management, making sure the portfolio is well balanced in this environment. So with that, I'm going to turn it back to Ben to see if there's any questions out there.
Chris, thank you. That was fantastic. Yes, we do have a few questions here. I will share first one. First question is, how does the upcoming midterm elections enter into your investment process?
Yeah. Like everyone, I am sure that we're watching with fascination, just like everybody else in the midterms. Um, it's great theater, but in terms of potential portfolio impact, it really doesn't enter into our process, right? Like we've shown this before, previous presentations, we've been through the numbers. History just shows the market really doesn't care who's in office, right? But it's driven by those data we're talking about, the technical, the macro, the fundamental backdrop, which, as we saw in this presentation, is still supportive of risk assets. We expect we might get some volatility creep into the markets around election day as winners and losers are decided and people try to pass out what it all means for society. But it'll subside fairly quickly. And as the market regains focus on the health of the economy, companies, and sentiment, that's what we'll be watching more than anything else.
Very good. Awesome. All right. Second question. What are you watching most closely for? A change in the signal or to get out of the market?
Thanks for the question. We get this a lot. I speak to it often in client meetings. Really, there's never one thing, right? We view the market on the weight of the evidence. So as we went through with the presentation, multiple levers that are constantly changing as new information becomes available. So, if you only kind of get focused on one data point or make a decision based on that, we may miss the bigger picture and the true signal. Um, and also we don't move entirely out of markets, right? But have a range of equity weights. We adjust based on the current environment. We're never all in or all out, but really adjust our weights based on a sliding scale, tilting into the most favorable setups by asset class and security. If risk rises too much, we reduce equity exposure, not eliminate it. And at the same time, if goes as risk falls, we'll increase equity exposure. We will send out trade notices to all our clients, post to our website with updated equity weights as we adjust your portfolios. So, our clients always have that clear picture of where our latest positioning is. All that being said, I think the level and path of interest rates are very interesting here, right? We have the 2 year over 4%. The Fed's at 350, 375. There's a disconnect there. I might keep a closer look on that for some indications. But other than that, again, we always look at the total picture and the total weight of the evidence.
Hmm, very good. All right, we do have one third and final question here. Do you incorporate private assets within your portfolios?
Um, yeah, it's getting a lot of press recently, both good and bad. Um, I think more bad press than good press, but we think they're very good and can be a good piece of the portfolio. Yeah, we do use them really, but on a very selected basis, right? It's not part of our normal actively managed asset allocation. Um, I think can be a very good investment, but they are very risky and illiquid, despite what some of those funds say, right? So it requires a lot of due diligence, a long-term hold, and we feel it's only appropriate for certain clients, right, that have that balance sheet and temperament ability to take on that risk. But if a client does meet that criteria, then yes, we'll use a few select funds for exposure in the space. We currently have 3 funds that we invest in for qualified clients. I'm sure your advisor would be happy to discuss your individual situation and if they are appropriate for your portfolio. Yeah, and again, given the complexity and lack of clarity around the funds in the space, I would not recommend doing it yourself, but rely on a professional like SCM that utilizes an open architecture platform, right? Has the expertise to analyze these very complicated products, and I just warn people, be wary of anyone who is talking their own book or tries to simplify this space too much, right? There are a lot of good ones out there, but also there are just some not worth the investment in. So I encourage everyone, if you're interested in the space, reach out to your advisor and ask the question. They'll be happy to answer it for you.
Perfect. All right. Well, that concludes this quarter's CIO Corner webinar. Chris, thank you so much for um, sharing here. And as always, you viewers, if you have any further questions, please don't hesitate to reach out either to your advisor, or if you're interested, please feel free to call us here at the office, and we're happy to get you connected with one. And we hope you have a good rest of your day.
Thank you, Ben. Thank you, everyone, for joining us, and see you next quarter.